traders, this is Jim Comiskey, Senior Market Strategist here at Archer Financial Services, coming to you live on Tuesday, January the 6th at about 2 o'clock in the afternoon for your edification. I'm working from home today. It's nice to have the ability to do so. Some of you may or may not have heard that the high today in Chicago is like 5 degrees Fahrenheit, right? And it's windy, which means it's about 30 below. I'm working from home. I'm here to give you some color on the metals complex, amongst other things. Apologize for the stutter there. Working on a new system, okay, and this one's going to be like a permanent new system that I can get up and move around with. So I'm thinking that I got a new microphone. The gain looks good, the volume looks good, everything looks good. If it doesn't, let me know. Bitch slap me. Okay. Color on the markets in general, and focus primarily on the precious metals markets, gold and silver. Currently, really what's taken first, fiddle here, if you will, is crude oil. Crude is down another $2.35 today to $47.60 a barrel. Feb basis. That's the lowest crude has been since April of 2009. Now, there's a lot of cheerleaders out there saying this kind of precipitous fall in crude is good. And I'll do another rant, way too extensive, later down the road, explaining why I feel as though this type of fall in crude is indicative of things that I watch. Indicators, leading indicators, global economy, the Baltic Dry Index, FedEx's earnings, UPS's earnings, Caterpillar's earnings, John Deere's earnings, crude oil, the most widely consumed commodity on the planet Earth, has literally dropped over 50% since just December, early December, in 1 month. Crude's dropped 50%. Now, you know that my thinking was that the Sauds, the Royal House of Saud, Kuwait, the folks at 33 Liberty, that's where the New York Federal Reserve trades, that's where the trading desk is, basically conspired to drive crude way south to punish Vladimir Putin for the Crimea incursion, takeover, and the Ukraine incursion. And now I think it's kind of snowballed, because you got Venezuela being punished in a big way. You've got North Dakota being punished in a big way, the Bakken shale oil fields, because these people have basically, floated loans with the understanding that crude oil is going to be above $80 a barrel. So what are they going to do when they go and refloat this commercial paper? I'm specifically addressing the boys in North Dakota. Okay, we'll talk about. I'll name names here if you bear with me a sec. But a fall in crude to this magnitude is actually quite alarming, because that money isn't necessarily put back into the economy. Lost my notes. All right, anyways, there's an estimated $20 billion in commercial paper that's due to be rolled. Now, commercial paper, for those of you that may or may not know what it is, it's short-term loans that banks will make to companies to finance day-to-day operations. Okay? And the whole idea, if you will, is predicated on their product being able to be sold on a local and world market, national and global market, at a certain price. Okay, so when these loans come back due, in North Dakota, there's going to be a lot of defaults. There's going to be a lot of layoffs. Let's move on. I'll talk about the crude later in another post. Anyways, for those of you that follow indexes, the Dow is currently down 220 points, the S&P down 26 points. Meanwhile, the dollar is unchanged. I want to talk specifically right now about bond yields. You say this sounds boring, and I don't want to sit in your finance class, Professor Comiskey, and listen about bond yields. But you know what? I'm honored and humbled that you've tapped into this rant. Therefore, sit down and shut up and listen to my rant about bond yields. please. All due respect. Currently, the U.S. bond is up 0.12, 1.12 to 148.11. Bond yields. That's the 30-year, by the way. Today, quite an alarming event occurs earlier this morning. The average yield on 10-year paper, 10-year notes, for the United States, Germany, and Japan have dropped below 1% for the first time, wait for it, ever. Even during the height of the Great Depression, circa 1929-1933, 10-year paper out of these three sovereigns, they were paying more than 1% to borrow money from people. Now, a lot of you guys have heard me talk about really high yields. Witness Greece, Portugal, Italy, Spain, Ireland. The amounts of money that they had to pay to borrow money on the global market was astronomical. In other words, the interest rate was really high. All an interest rate is the cost of money. Now, when you get interest, the opposite side of the coin, when you get interest rates really low, okay, those are the sovereigns that money managers the world over are placing faith in, that all they want to do right now is preserve their capital. They don't care about yield. They don't care about nothing. They just care about safety. This is the environment that we are in. When prices of government paper, no matter what the sovereign is, be it U.S. in this particular case, U.S., Germany, or Japan, when those prices go up, the yield goes down. You see it? So everybody's bidding up all this paper for these three sovereigns, the three powerhouses, and driving the yield down below 1% for the first time ever. It's a very, very, very alarming trend. And I'll show you why. First of all, let's just show you that would be my puppy, my 70-pound puppy. If he starts to act up, hey, try and ignore him, okay? He can't help it. By the way, his name is Charlie. He's a golden doodle. Here's a yield curve. Okay, this is the United States yield curve. I'll try and get that focused. Issues with the new equipment, but we'll get there. Okay, bottom line is any yield curve goes from overnight paper, the yield on overnight paper, okay, generally like Fed funds, to 30-year paper. Okay, now right now the yield curve is about as flat as a 10-day-old beer sitting out on a deck in the month of August. A flat yield curve is indicative of very little growth that the credit markets anticipate going out 30 years. Credit markets have been wrong before. But right now, 3-month paper, overnight paper, goes from 0%, zero, in other words, my English friends say fuck all, to 2.51% for a 30-year bond. Let's do the math. Shall we? Bonds are sold in the States, bonds are sold in $100,000 increments. Okay, at 2.51%, you are being paid by the United States government to lend them $100,000 for 30 years. You're being paid $2,510. Really? With the credit markets albeit destroyed by helicopter Ben Bernanke, and the market quite worried about this fall in crude, subsequent fall in world indexes the world over, obviously, redundantly repetitive in my humble opinion, things are not going to look good here. Okay, going forward on the short-term basis, medium-term basis. I had a brilliant question from a gentleman. Oh, perfect. I'll address it. Casey McDonald. Casey, can you let me know what the industry considers the following time periods? Near-term, short-term, mid-term, long-term. Casey's view, near-term, days to month. Yeah, I would almost say hours to days, Casey. Short-term, I would say days to weeks. Midterm, I would say maybe 3 to 6 months. long term, in these markets, all things being equal, I would say 9 to 12 months, a year. Thanks for the question, Casey. All right, so basically this yield plunge is approaching last October's flash crash squeeze in yields. One of the reasons, and I'll get to this, and I'm running out of time, but I'm going to try and put up a couple rants today. 10-year note. Okay, large specs are net short only 26 billion 10-year notes. So they're getting their nuts squeezed right now. Okay, they're short the price. As the yield goes down, price goes up. The yield is plummeting. The price is rallying dramatically. Large specs, net short 26 billion in 10-year paper. In the S&P, large specs are net long 17 billion in notional. And the S&P has dropped, 40 points in the last 2 days, 400-point Dow crash. This is the October 15th flash crash in Treasury yields, okay? And basically yields in a 2-day time period went from 2% to 1% on the 10-year note. It's always indicative of the fact that the market is scared shitless, bottom line. So, free money in bond markets shows the global economy is still struggling, courtesy of Bloomberg. The world's richest nations are borrowing for free. Taken together, the average 10-year bond yield of the U.S., Japan, and Germany's dropped below 1% for the first time ever. That's not good news. Okay, the rock bottom rates, which fall below zero when inflation is taken into account, show investors think we are going nowhere for a long time. That quote from a gentleman named Stephen Englander, global head of G10 Foreign Exchange Strategy Trading at Citibank. Also Comiskey's opinion. Could a Russian default be in the cards? Okay, Russian, basically their credit default swaps. You're going to think, again, follow Professor Comiskey here. It's not that boring, it's legit. And I'll get to how it's going to impact gold. Russia's, all right, so, by the way, I hope everybody had a happy holiday and a happy New Year's. And, I've been a little bit remiss, taking a little time off, spending time with the fam, loved ones. Hope you have as well, and I hope you had a great holiday. But this news is a little bit old. It was prior to me basically fucking off with the family. Russia raised interest rates to 17%, their Fed funds rate, their effective overnight lending rate, in order to shore up the ruble, their currency. Okay, their currency has crashed at close to 40% since the whole Crimean invasion, and their stock market is basically off 50% just in the last week and a half, 2 weeks. So, it is in my humble and, yes, learned opinion, big moves in the markets are almost always preceded by one of two things. Big move in energy prices, north or south, and big moves in currencies. Look it up, Google it, pull all the charts you want. Speaking of charts, this is what happens when a sovereign's currency collapses. By the way, gold was the second best currency in 2014. But gold's not a currency. That's what Helicopter Ben says. Must be true. Really? Gold's the one and only true currency, along with silver. You could throw platinum and palladium in there too. More industrial uses there, but gold can be measured in any sovereign's currency. Okay, it was up 13% versus the euro in 2014. It was up 6% versus the British pound in 2014. It's courtesy of Zero Hedge, by the way. Okay, the dollar was the best performing currency in 2014. That's why the gold market, the gold price in dollars, hasn't really moved much. Get it? Got it. Let's see what happens to a currency when their world goes to hell in a handbasket. Okay. This is the Russian ruble, which, all right, I'm sorry that the light's kind of bad. I'm working on the studio and stuff. Trust me. Gold's second best performing currency of 2014. Right here is the Russian ruble. Just in the last month and a half, the Russian ruble has dropped almost 50% relative to the price of gold. In other words, gold has rallied 50% relative to a ruble. What happens if the U.S. dollar falls out of bed? U.S. dollar being, or the U.S., rather, being a far larger economy than Russia, despite what Vlad Putin would have you think. What do you think would happen to the price of gold if the dollar fell out of bed? Currently, the dollar's basking in the sun. It's enjoying its heyday because it's one of the few safe harbors in a really bad storm. That can and will change, and it can and will change rapidly. I'm going to have to drop here. This is 16 minutes, and I don't want to overdo it. I'll try and post a couple of rants this afternoon. But for right now, that's the first one, and I hope you enjoyed it. And, as always, honored and humbled that you've taken the time to listen to me, and listen to me get stuff off my chest. I do this gratis for the Army of Comiskey. Go on Twitter, Army of Comiskey, Twitter feed. I'm there. And basically because, as one of you guys, straight up, but I've fought the fight in the pits and in the trenches for 30 years, so I kind of think I know a little bit of insider stuff. And I'm totally willing to share that insider stuff with the Army of Comiskey. So, that's why I do this, and I feel better. I get it off my chest. Yes. Now, I'm not sure if Don's going to be able to post this, but my contact information, if you'd like to speak to either myself or Jeffrey Wagner, if you're in the States, please dial toll-free 888-935-7979. If you're outside the States, please dial 312-242-7996. Twitter feed again, Army of Comiskey. If you'd like to email me, jim.comiskey@archerfinancials, plural.com. Look forward to hearing from you guys. As always, honored and humbled that you've listened. Go hug a loved one, because truly that's what it's all about. But for now, that is all. Meantime, again, look forward to hearing from you. Good luck, good trading. Take care, guys.